Hello and welcome to ActivTrades News. I'm Leah Milner and I'm joined by Neal, Kimberley, currency analyst. Today we're going to be talking about the European equities market, sovereign credit ratings, the Bank of England's decision not to cut interest rates, and the implications of all of these things on currencies around the globe. Hi Neal. So first of all, on the European equities market, we saw that especially European banks plunged significantly after the Brexit vote. In fact, even more than UK banks, and the drop was actually bigger than sterling. What's coming up now for the banks in terms of reporting season?
I think obviously with the interest rates where they are in the Eurozone, negativity of that, essentially the net interest rate margin, net interest margins are being suppressed. Mm-hmm. So it's difficult for the banks to make money. The banks, particularly in Italy, are carrying a tremendous amount of bad loans. There are arguments out there that the Eurozone banks have built up the capital, but the performance would suggest that at the moment they're still reticent to do too much new business. Mm-hmm. There's also the knock-on effects. If you're looking at Italy, you can't look at Italy in isolation. You've got to look at all the people who have lent into Italy and who's got the risk there, just as we had to do with Greece. Yeah. You cast your mind back to the Greek crisis. The Greek banks had a tremendous amount of problems, but as was subsequently discovered, so did the French banks and the German banks who lent to the Greeks. Yeah, and there were conspiracy theorists within Europe who were saying, well, actually the one reason why the Greeks had to be bailed out was because a lot of non-Greek banks would have suffered immeasurably if the Greece had gone under. So you have to look at it from within that context, and then, given the fact that the Eurozone is not firing on all cylinders anyway, given the fact that the outlook for the Eurozone isn't looking particularly lovely in the wake of Brexit. I mean, last night the IMF downgraded world growth, they downgraded UK growth, but even after their downgrade of UK growth, that was still higher than what the IMF expect for Germany and France. Yeah. So within that overall context, can you really see why Eurozone banks should bounce back? And just pushing that further on, that probably means that the ECB, although they're not expected to do anything on Thursday, will probably have to revisit ultra-accommodatory monetary policy in the months going forward, and or allow the euro to take the strain on the downside. Now we've dipped below 110, the figure, on Wednesday morning. The market is beginning to price back in the possibility of a Fed hike. So what you're seeing around the world at the moment is the ECB ultra easy. We've got the Japanese central bank meeting next week, possibly going to ease policy again, combined with new fiscal stimulus from the Abe government. The Bank of England, who we'll go on to, may not have cut yet, but may do so down the line. The Australians, in their RBA minutes of Tuesday, were talking about the possibility of a cut. The New Zealanders have brought in macro-prudential measures on real estate purchases, which means they have room to cut. All around the world, outside of the United States of America, it's easier monetary policy. Even the Chinese have been allowing the yuan to weaken, albeit traders should be aware there's a meeting of the G20 this weekend in Chengdu, which may explain why the Chinese have fixed the yuan slightly higher today. They may be wanting to placate the Americans. And by the way, before I mention Chengdu again, there will be a key meeting on Saturday morning between Jack Lew from the US Treasury and Mr. Aso, the Japanese finance minister. And I think that's going to be very, very interesting for what happens to the dollar yen into the Bank of Japan meeting next week.
Interesting, okay. And so you don't think there's that much hope of us seeing improvement in European equities throughout the rest of 2016?
I think you've got to differentiate between European equities as a whole and bank stocks.
Particularly, yeah.
Bank stocks, I wouldn't put my money into because I can't see where the earnings are going to come from. As regards the Eurozone as a whole, if I'm right and the dollar's going to be king, Eurozone equity, Eurozone exporters are going to pick up an advantage in the way they sell stuff because the euro is going to be lower. A bit like if you think after Brexit. Yeah. The FTSE 100 went up because you've got a lot of companies in the FTSE 100 that make their money in dollars and suddenly benefited from the big fall in sterling. And the FTSE 250 laboured because all those companies in the FTSE 250 that sell stuff in sterling or have exposure or importers are going to struggle. Yeah. So like everything, you have to be choosy about the way you do it. It's not a blanket bet.
Absolutely. And then in terms of sovereign credit ratings, Britain lost its final AAA credit rating this week. But the market didn't really react as one might expect.
No, I mean, if you
going
cast
on
your
there?
mind back to when it started to happen 18 months ago, 2 years ago, when we last did, it was a big thing, you would have
Yeah.
thought it was just the end of the world. But the bottom line is, AAA minus, AA plus is the new AAA. The credit rating agencies understandably reacted, or the last one understandably reacted to Brexit. Whether that gets reversed down the line, if Brexit's not such a problem, we'll have to wait and see. But does it really matter? I mean, AAA, AA, I'm looking at what the yield is on gilts.
Yeah.
And at the moment, we can see that the gilts market's held up very well, even though the Bank of England didn't cut rates, didn't increase QE. So people are still looking at UK PLC, if you will,
Yeah.
and thinking, okay, there's value to be had here because of the fall in the pound. And if you just cast your mind back to the events of Monday/Tuesday, where Japan's SoftBank comes in and pays £24 billion worth of cash for ARM Holdings, the UK technology company, the Japanese have just had a real bargain, essentially,
Yeah.
because you don't do a deal like that in 3 weeks. That deal's been talked about before the referendum. Those guys have said, okay, we're going to go ahead now, and guess what? Sterling yen is way, way lower, so we're picking up a bit of a bargain here. So you can understand why the new finance minister, Mr. Hammond, said, we're open for business. The Japanese are saying, Brexit or no Brexit, there's value to be had in the UK. And I think even within the last 24 hours, Wells Fargo, one of the most profitable American banks, has spent £300 million on a new building in London. So we've gone from Project Fear, which then became Project Smear, and now we're basically Project Business as usual.
Absolutely. And turning to the Bank of England's decision, the Monetary Policy Committee's decision last week to actually hold interest rates, that was a bit of a surprise to most people, I think. What do you think the thinking was?
Well, I think Mr. Carney had a case of old King Cole, didn't he? He marched us all up to the top of the hill,
Yeah.
and he marched us all the way down again. And I suspect the tone of his comments when he was talking before the Treasury Select Committee, which led people to believe that they were going to cut.
Yeah.
I'm not sure whether he'd had a kind of chat with the other guys around the table, because it clearly is, although Carney is the Bank of England governor, he was the only person, in my opinion, who kind of stood up in the post-Brexit environment and acted like an adult.
Absolutely, yeah.
But when you're in that room, you're only primus inter pares and everybody else has got to vote. So I think he was persuaded that there's not enough data in yet to justify going to 0.25 or 0%, or even to increase QE, and that we should wait until August at least. It's interesting that last week ECB Council member Linda said that the ECB will be making an evaluation about the implications of Brexit not before September.
Right.
So even August may be too early. But the bottom line is, the Bank of England has to make a judgment. We have a new government which is taking off the shackles of spending, so they're going to be borrowing money to put it into the system. If the Bank of England then cuts, are we going to overkill here? Especially given the fact that, even with the Brexit scenario, the IMF is still saying could be 1.7% growth in the United Kingdom in the next 12 months. And despite the fact that we've seen, as we discussed, good investments coming into the UK in the last week or so. And the other thing I point out, because I think we've got a change now in the sterling market, is we sold the pound on Brexit. It was a binary decision that came out of the referendum which shocked the market, and we sold the pound. It subsequently bounced back up from 128 lows to back up to 132. Now today, it's 131.80 as I'm coming on air. There is some depth coming in back into the market. For example, in the options market today. There's £1.4 billion worth of expiries at 131 the figure. There's another £1.3 billion worth of expiries at 132 the figure. So sterling in a thin summer market is probably going to remain somewhere around those levels. The question is now, where does it go next? Now I'm wondering myself if we've had the bounce. I like this idea that the Federal Reserve is going to see through Brexit and move towards tightening. They don't even have to do it, they just have to talk about it. If they start to talk about it, the market will grow the dollar up, which is what we're seeing broadly. At the same time, if the British government's going to spend a load of money and borrow it, you've got to borrow it off someone.
Yeah.
We're relying again on the kindness of strangers, as Mr. Carney described it before the referendum. If at the same time the Bank of England is going to cut rates, which they may, then the yield that those guys are going to get on those gilts, for example, is going to fall. That might dissuade them. the quid pro quo has to be a lower pound. Because if the pound's at 132, it might not be enough. But if the pound's down at 125, 120, then it becomes more attractive yet again. And I think the difference now in the sterling market is the pound dropped after Brexit because the people voted for Brexit and the market reacted. If the pound now falls again, it's because the market's assuming or putting together two and two and saying government policy plus monetary policy lends itself to a lower pound. Now that's a different way of things. This is a more measured move, a more articulated move, rather than the post-Brexit knee-jerk sell-off. So I'm just wondering myself whether the pound is topping out a little bit, both because I can see reasons to sell the pound now, but more predominantly because I can see massive reasons for buying the dollar, just as I can see reasons for buying the dollar against the yen, against the Aussie, against the Kiwi, and to a lesser extent against the euro. But next week, if we get some adverse stress test on the 29th of July, I think the pressure on the downside of the euro could re-emerge again.
Okay, well, thank you for that. Thanks very much for joining us again this week, and please join us next week when we're going to be looking at more financial news and economic forecasts. All the best.